Welcome back to Freightonomics, now a component of the FreightWaves Today segment on Thursday. I'm Zach Strickland, head of Freight Market Intelligence here, and we do have a really good show today. We're going to have special guest Ben Peterson. We're going to bring him out to talk about the shipper perspective. He has written a few sit reps for those Sonar subscribers out there, and Craig, of course, explained them a few minutes ago. Long-form research, but also deep dives into some data and strategies. So Sonar subscribers have access to deeper contextualization, research, forecasting, modeling type capabilities with the data. So we'll get to him here in a bit. But first, I think, we talked about, you've heard us talk about JB Hunt on FreightWaves today. We're going to go through that here in a minute. But I think setting the tone, keeping with tradition, market in two to get things kicked off here, just to give a quick table set on where my head's at in terms of the freight market. So if you guys are ready in the back, we can pull up those charts whenever you guys are prepared, if I want to count myself in or not, or we don't have to do it yet. There we go. All right, so 3, 2, 1. First one's up, S-Try, Sonar Tender Rejection Index. You see this all over FreightWaves today and all over Freightonomics, and it's going to be that way for a while. We came out of the holiday, which traditionally, the call out here is that we see normally like this peak. So we settle down in June, and then rejection rates pop back up around 4th of July. That is not the case. We're kind of we had a plateau in June, and we had more of a rollover around the 4th of July. And things are stabilizing now, and they did drop fairly quickly coming out of the holiday period, but now they look to be flattening out around the 16% threshold. Still very, very high. And I think this is going to be the read moving forward is, what does this trend line, if you were to draw a trend line from that peak value in early June, ignore the holiday noise for a bit, and look at that trend line, and it points to still a very tight market throughout the rest of the year, and I think that's exactly what we're going to see. Let's look at the spot rate chart next. NTI. So spot rates, more emotional, a little bit more noisy, and also the relationship between spot rates and the rest of the market has changed dramatically since the Montgomery-Carib ruling. Broker liability, carrier vetting is now increased, so we're going to have a new reset here. This is going to be a totally new threshold. Spot rates and contract rates are going to have a different relationship moving forward. I think we're going to see this baseline increase. However, a lot of emotion in these rates while they're figuring things out. We are starting to see a little bit of a stabilization there at the end of that chart. You see that line turning more to the right there than straight down. So following with tender rejection rates, we're starting to see a little bit of consistency in the day-to-day rates. Let's go to the next chart, STVI demand. We're going to talk to Ben a little bit later about the PPI. It's also going to break some of this down for you, but demand staying on point, staying exactly where it's been. And then the last chart I want to show you, contract versus spot. Both of them still going up, pretty much. I mean, we've got a spot rate coming down after the holiday, but they're still very elevated. Contract rates are up roughly 15% year over year. So this is going to be an ongoing thing. We've got several months of this cycle, I think, at minimum left, pending some sort of weird economic noise or demand side signals. Rates are up, spot rates are way up. And just because they came down in the near term doesn't mean that I think you can take too much of a breath there from a procurement strategy standpoint. So we did have some economic releases here over the last week. This is a big week for economic releases. And soon I may have an economist join us here on the show, hopefully here in the coming weeks. But for now, you got to deal with me reading some of this data. So CPI came out. The reason CPI matters, the reason you care about CPI is because it sets monetary policy moving forward. It has an influence on economic demand. How well is the consumer doing in relation to inflation? Didn't mean to do that rhyme there, but CPI was 3.5%, down from 4.2 in May. So that's a fairly good signal, but it's still not out of the woods yet. A lot of this, of course, a derivative of energy, some of that gas price coming down. We just heard about it in the retail sales figures. PPI, also coming down from last month's highs. And if we hadn't had that reignition of the confrontation in Iran, Strait of Hormuz, still fairly shut down, I think we could take this as we are moving past the peak of inflation. But since that has changed, I think we're still we're not quite out of the woods in terms of having to be concerned about inflation and how it's going to influence monetary policy. If the Fed does choose to take this as hey, we can control it, which if you heard Dr. Zach Rogers on last week's Freightonomics talk about this, that's not necessarily the right thing to do, because if you increase interest rates, the borrowing rate, you're influencing demand side dynamics only. This market is very supply centric. The thing we're talking about in transportation isn't a demand driven cycle turn. It's capacity, supply side that's changing, not you actually want to lower interest rates to encourage investment in that scenario. Because if people aren't able to take out a loan to buy a truck or equipment or grow their business, capacity is not going to grow. So I can make the argument that increasing interest rates actually hurts in the long run on this cycle. However, I'll leave that to more of the experts. The last big report this week, removing from inflation here, retail sales. You heard JP Hampstead talk about this a little bit on the FreightWaves today, but up 0.2%. If you remove the influence of gas prices, it's actually up 0.7%. But one of the reasons I don't love retail sales figures is because they're not adjusted for inflation. And of course, the headline figures tend to be seasonally adjusted. I hate seasonal adjustments on any figures that you give me at this point, because what is a traditional season since the COVID pandemic? We've really broken a lot of normal seasonality out of the equation. So this, I think the 0.7% increase month over month in retail sales, if you exclude gas, is actually a very positive figure. It means consumers are resilient. Some of the things that did drive this figure: non-store retail. We had Prime Day in June this year versus last year was in July or August, I believe. And so that's going to make the comp year over year a little bit different, a little bit wonky. Again, seasonality changed this year versus last. Prime Day, of course, a big driver of the e-commerce. Sports and hobbies, also up 1.3% month over month. FIFA World Cup has been driving a lot of new sports equipment purchases and things like that. Love FIFA, by the way, and the World Cup. I'm not a big soccer guy, but I have been watching a lot of it, and you can see it reflected in the retail sales, so that's good news there. Autos, also surprisingly up 1.9% month over month. And electronics follow with a 0.8% up reading. So there is some positive takeaways here. None of these figures are adjusted for inflation, however, but I think there is still a good sign that consumers still like to spend money. The American consumer cannot be stopped, no matter what, I don't think. But doing a little bit of research this week, we can't necessarily, I don't want to be doom and gloom, but also I want to tamp down some of this, I don't want to be overly exuberant either. You can tell that I have been reading my economics lately. So some of the concerns moving forward from demand side economics. We've got a consumer that has been spending through a period of time where maybe they shouldn't have been spending. The savings rate is still roughly 3%. So that's historically low. That is not where they want it to be. It means that a lot of consumers are spending their savings and not holding it back. That is not what many economists consider sustainable. So there's weakness there. They did start having more discipline on their credit card spending. We did see revolving credit come down over the last month from April to May, but that was also traded off for the non-revolving, it was revolving credit came down, non-revolving went up. So we saw the auto loan purchases, that's the type of credit that did increase over the last period of time. So debt levels still not great, not terrible, but there are some risks moving forward in this economy. So that being said, there's a few stories that I want to call out that you guys should check out on FreightWaves.com. Make sure you read the latest TL, LTL rates to hit new highs in Q3. This is TD Cowen, AFS Freight Index report that Todd Maiden writes. Definitely something worth checking out. Gives a little bit further context. If you're a Sonar subscriber, if you watch Freightonomics, FreightWaves today, you already know most of this stuff, but I think it's helpful to have that additional perspective. The report said that more than 48,000 non-compliant drivers have been forced out of the industry year over year. That is, for context, that is a huge number. There's millions of drivers supposedly available, but 48,000 is not a small figure, and I think it may be understated even in this context. So definitely check that out. The next article, which is probably, if you read nothing else on FreightWaves.com, read this one. Stuart Churl's, no, it's not this one. This is the Port of Long Beach record. This is sort of a byproduct of the next article I want to call out. But Port of Long Beach, third highest June on record. And then you have the next article, which is going to interview Dr. Noel Hasegawa. I hope I got that name right. I'm sorry, this is the turbulence. This is the exact article I wanted to talk about. Traditional peak shipping season, no longer a thing. And this is the new CEO of the ports out there, talking about how year-round waves of cargo have replaced this traditional peak season that would normally for imports happen around August, late July, early August, and into September. That's no longer the case. It looks like, and again, you can blame some erratic trade policy. You can discount these as one-offs. But the reality is that we really haven't had a normal seasonal summer peak season as was defined as before COVID in a long time before COVID. Like I said, if we pull up the IOTI, so this is the inbound ocean TEUs index. This year, you can see it's not necessarily a peak, sort of mirroring what I was talking about with the truckload space, more of a plateauing. And this is a moderating trend. Once they, increased their ordering practices in early June after the announcement of the tariffs, they really didn't exceed last year. Last year is in yellow there. 2025 ordering volumes hitting all-time highs. This was higher than COVID, by the way, if I were to pull this up in a lot of situations. And it was that reaction to the cost prohibitive tariffs on China. So once those got removed, everyone had to catch up and then also pull forward simultaneously because we still didn't have any clarity around what the tariffs were going to be moving forward. So we can talk about record volumes in June. I think that chart also really points to a strong July and probably into August, because this is a 14-day moving average on the IOTI. It also is representative of bookings of containers that haven't yet left the ports across the ocean. So you've got a minimum of about 15 to 16 days before it hits the ports here. So that means we've got, 14 days left, 15 days left in the month of July. About the time that ends, we still have a lot of volume coming in. So anybody operating around the ports, drayage operators, JB Hunt Intermodal, I don't know if you guys heard, they blew the doors off. JB Hunt, of course, is more domestic intermodal volumes. Imports tend to influence the international sector first before getting transloaded into the domestic side. So JB Hunt, I'm still looking for a bullish outlook on JB Hunt. If we look at JB Hunt's earnings, of course, Todd Maiden covers this on FreightWaves.com. Some of my key takeaways that maybe Craig and JP and Julie didn't cover on their show. I think the fact that their truckload sector really, it went negative in terms of OR. It was actually over 100 OR. Purchase transportation looks like they were caught a little bit off guard here. If you look at their equipment for the truckload sector, it's down almost 400 units year over year. And this is normal. I'm not really saying this is kind of a negative. It's just, this is typical of a carrier that has now been caught off guard with their book of business has grown because the shipping community has now outpaced what their available capacity is, and they had to purchase a lot of that transportation. They'll recover, they'll get this back, but it might be having some sort of interplay with ICS and brokerage, which margins are contracting year over year, not necessarily month over month. It looks like they're trying to right size some of their contracts here. All positive things. Domestic intermodal, though, the reason these guys take some of these negative hits is because they are so broad and well diversified within the space. You heard Craig and company talk about this on the show before, but when you have domestic intermodal, you have dedicated, you have truckload, you have brokerage, all of these things sometimes don't move in tandem with one another. Something that helps intermodal sometimes hurts trucking and vice versa. So we really have to take this with a grain of salt when you see some of these ups and downs. Overall, they're winning heavily. The domestic intermodal volumes, you saw the chart, huge. One of the charts, go ahead and bring up domestic intermodal. It took me a long time to figure out, to actually see this chart for what it is. For those of you that don't look at loaded domestic container volumes, which I'm sure a lot of you don't, this chart, it looks a lot like the truckload chart in years past, like the COVID era chart. Domestic intermodal volume swings do not happen on this scale. This is a 13% year-over-year increase in June that you're looking at. That is very, very uncommon. So the volume growth in intermodal cannot be ignored here. The question is, can it grow further? Can they handle more? The peak season for domestic intermodal, like I said, is actually later in the year, around September, October. You can see it reflected on the chart. It kind of rises as the year ends. Does this volume get higher? And I think that also brings into the question, does service, it's already getting a little bit slower as reported by Stewart in the article. Does it still have that infrastructure resilience? The drayage community is exposed to this heavily. So that's what I wanted to cover there on the first part of this segment. I think we need to take a quick commercial break. And after the commercial break, we're going to bring Ben Peterson on to talk about that shipper perspective. Stay tuned and we'll be right back. Welcome back, everybody, to Freightonomics. I'm Zach Strickland, and I'm bringing on a guy that, rarely in my experience in our industry do we get a chance to talk to the other side of, the perspective. Ben, of course, used to be, now works at Sonar, thankfully, used to be the manager of transportation procurement at General Mills. So he's seen everything from the lens of a shipper, and I want to welcome him to the show to make his FreightWaves debut on TV, helping me out today, bringing on a guest, but also he has got a plethora of knowledge, and I love the perspective here, Ben. You have written a couple of pieces. You're now taking over the PPI. For those of you that have been following FreightWaves and Sonar for a while, the PPI is one of our most popular data points that's actually not had the formulaic approach to it as much as you have just provided here, and you found a way to do it and apply it historically too. So Ben, first of all, welcome to the show. Give us a quick introduction to your background, and then we'll get into the PPI.
Yeah, absolutely. Thanks for having me on. Excited to be here. Like you said, it's my Freightonomics debut. So joined Sonar. I've been with the company for about a year now. Prior to that, I spent nearly 10 years on the shipper side. Most recently managed the transportation procurement team at General Mills. And then prior to that, I managed middle mile transportation procurement for Target. So I have a lot of experience on the shipper side of things. And then before that, I spent time at a 3PL as well. So I've been in the transportation industry in one form or another for about 16, 17 years. But yeah, and that's why I joined Sonar. I think have some unique perspective, and I get to work with a lot of our potential and current shipper customers to really help our data make sense to them internally, to really take their data and mesh it up with ours and drive efficient and effective transportation decisions.
And we are glad to have it here. So Ben, without further ado, I pulled up a chart of the PPI that you actually produced in your piece here. Talk about the PPI and what it's actually doing, and then I want to get in a little bit to the methodology and some of the data points that it's getting into. So give us an introduction here.
Yeah, absolutely. So the PPI is our pricing power index. Essentially what it's doing is giving a high level overview to understand where the pricing power sits between carriers and shippers. And it's on a scale of 0 to 100, with 50 being more of a neutral environment. The higher that number goes, the more it leans towards the carrier's favor, and the lower that number goes, the more it leans towards the shippers. As we've seen over the last few years here, it's been in the shipper's favor. Pricing's been very aggressive. There's been adequate capacity, but towards the back end of 2025 and obviously into 2026, things have shifted. Naturally, before that was more of our market experts looking at our market indicators and our data and then making a qualitative assessment of what that number is. So I took a little bit of a different approach, and me being a very analytical thinker, wanted to view if we could, simplify that a little bit or make it a little bit more quantitative. And so I took some of our major market data sets, a lot of the ones that you had talked on with our tender volumes, our rejection index, and then a lot of our pricing components, and really put them on a scale. Yep, as shown here. And what that does is it looks at the 5-year history of each individual metric, and then it puts that within a percentile rank for that. And so what that does is basically it makes that all consistent. So those are measured in different ways, right? So volume or percentage for rejections or in dollar values. Right. What that allows it to do is then be able to score on a same type of scale. And so from that, it totals, and it's using a weighted methodology to ultimately generate what the PPI is. We have back tested it. I did a good amount of back testing, and it generally tracks, right? And so after a lot of trial and error, the methodology seemed to be pretty firm.
Yeah, I like that you're into math like me. I want to pull up that box one more time here, because it also, like, I didn't have a way to really validate this signal cleanly until I saw this inside of your explanation. But we talk about this market being very supply centric. You know, I just went on a rant about it just a few minutes ago. But this box, if you look at this, so you're looking at a lot of different indicators. For those of you that don't know sonar, I'm just going to make it simple for you. There's a couple of demand side indicators: rail, IOTI, ASTVI, all demand side, they're volumes. So basically, when you see a high percentage, that means we're in a very elevated demand side state. If you look at these volume indicators, I mean, IOTI is up there, but you know, I just showed you that that's not necessarily, it's a little bit of seasonality. ASTVI, accepted tender volumes, is in the 20th percentile. This is super low. I mean, and again, it's not a total picture because we're ignoring the rejected tenders. So ASTV is probably the low estimate of demand right now. But that being said, STVI is also not necessarily super high in the terms of overall percentage. But when we talk about this being a primarily supply-centric environment, that's really an indicator that really sticks out to me. And S-Tri being at an 84, NTI being at a 96.9 percentile. Spot rates are in the 97th percentile of the last 5 years, and that includes COVID, mind you. That's insane to me. So kudos to you for pulling this together. I think it's definitely, and of course it's available in the Market Monitor for those of you that subscribe to that. It's also, is it still available on the vlog, Ben? Or
I'd have to check. I know it's in Market Monitor, and I'm not sure if it's in the blog or not. But
anyway, great reading. And what's the current reading? Was it around 70?
I think it jumped from 70. Last week's was 70, the debut of it. And a lot of that was influenced by holiday volume, obviously, with the 4th of July. And it rebounded pretty heavily this past week up to 79. And so, yeah, the capacity didn't downsize, right? Demand shot up. I think one thing that's interesting to look at, too, when you talk about ASTVI in particular, and I was looking at this morning as we were talking about some of our daily watch stuff, is ASTVI is the lowest it's been in comparison to the last 3 years, but STVI is the highest it's been in comparison to the last 3 years. And that just reiterates the rejections, right? And that's going to give some additional understanding there. But when you look at ASTVI, that's actual execution, right? That's volume that is being accepted by the carriers and actually moving throughout the network. And I think that's a really important indicator as you start to measure what's moving throughout the country.
Yeah, I agree. It is a pretty solid. I like looking at ASTVI and STVI together, because ASTVI in a tight market basically tells you where's the threshold. How much can carriers handle? When rejection rates are above 10%, that means that carriers don't like to turn down existing customers to haul other freight generally, because they know they have to buy that customer back somewhere down the line. And so it's an interesting component, because I'm not seeing ASTVI really grow over the last bit. And that would be the indication that capacity is actually becoming more available, growing, more consistent, whatever you want to call it. And we're really not seeing that cyclical signal around how it's going to turn in the near term. Rejection rates are going down, but it's largely because we're seeing the seasonal kind of flow of demand fall off a little bit too, coming out of June. But the next piece here, of course, sit reps. For the Sonar subscribers, you're well aware of these. You just wrote one. It's not out yet, but you wrote a shipper of choice one that was preceding that. And I think that there's a little bit of overlap here, but this one that you just wrote, I want to tease everyone and be sure to look out for it if you are a Sonar subscriber. If not, check out FreightWaves.com, which we generally cover these. high level on FreightWaves.com. If you want to get in the weeds, you got to subscribe. The sit rep that you wrote here is basically explaining how shippers need to view, you call it optionality. I call it flexibility. I call it adaptability. Like, it's really an article or a deep dive into some of the strategies that shippers can employ to help them. I talk about JB Hunt having a hedged portfolio of business. Shippers can hedge their transportation networks to markets like this, and it calls out obviously the sonar signals and a lot of the sonar data that you can employ in some of the strategy around it. So it's a little bit of a use case there, but talk about this sit rep and why you wrote it.
Yeah, I mean, it was influenced. I joined a panel last Thursday, and the focus of the discussion was around managing risk and building contingency plans. And so that really sparked my interest in expanding on that from a shipper point of view. And I think often as we get into, the markets that are shipper favorable, a lot of things are built on efficiency. And so they optimize costs and don't consider some of the alternatives. And when that market flips, some of those are exposed rather quickly. And on the shipper side, cost is a major component, obviously, but you also focus on capacity and you focus on consistency. And those things start to go out the window if you don't have plans as the market tightens. And so this latest sit rep focuses on the optionality and how you need to evaluate that and build it into your network. It focuses on things of carrier optionality. What does your tender waterfall look like? When your primary rejects, what is your strategy for going to secondary or tertiary carriers? And not just having any in place, but having a foolproof plan that will actually allow those carriers to execute your freight if needed. It talks about the spot market. And for some shippers, they're very hesitant to enter a spot market tool into their network, just given the perception of what that means. But there's really strategic ways to do it. And in any given market, a spot market tool can prove beneficial. And so thinking through that strategically, I think ultimately with a lot of the sit reps, the intent is to really start critical thinking, especially now. So as the market has shifted for shippers, it needs to begin thinking out. They need to think outside of the box, because the typical ways that you saved costs last 2 or 3 years is not going to be sufficient right now. And so that includes things like mode conversion, looking at your truckload lanes and saying, hey, is there an opportunity to shift these to intermodal? Obviously, we've talked about JB Hunt's doing very well. Some shippers are taking advantage of that, but also there's more unique styles of mode conversion. Could I break down some of my truckloads that aren't actual full truckloads and ship them LTL? Taking freight off of the spot market and moving it contract if it ships consistently enough, or vice versa. And so just really evaluating all avenues you can go down to potentially capture some of that cost savings in a different manner than you've been able to the last couple of years.
Yeah, I like the way that you made it approachable too, because a lot of the strategies that you talk about, in my experience, some of the companies out there don't really have a lot of background or experience in exploring multiple types of strategies, such as, I love the one box that you call the backup carrier myth. And that made me chuckle a little bit, but I love the concept there. It's like, just because you have a carrier sitting there that accepted something from a year ago, and now they're number 2, what makes you think that they're going to be ready to go when you come knocking a year later when the market flips? I think that's a fantastic call out there, because it's like, we all do this in every job that we get to. We just kind of start taking certain things for granted. And I think when the transportation markets are working, shippers, just like any business, they start just thinking that it's always going to be there. And I think these are great ways to think about how you need to consider, you don't have to pick all of these strategies in once. And of course, the data, of course, helps you make it a little bit more informed, so you don't just have to go in dry and not know exactly what you're doing. Which particular, you worked in the shipping community during COVID. Which of these strategies do you think is probably the most easily levered in an environment like that?
That's a good question. Yeah, I was with a retailer during COVID, and obviously we all remember the toilet paper crisis. So that was a fun experience. I think when I think about the contingency plans, it's the tender waterfall is the most actionable, but it's strategically thinking about how you implement that tender waterfall. And I think your call out on the backup carrier box was one that I put in intentionally, because there's a right way to do it and there's a wrong way to do it, right? To go forward and just put in a rate that a carrier provided in a bid 6 months ago, and you don't tender them any of that freight for 6 months and then expect all of a sudden they're going to handle a load that falls through, is unrealistic, right? But if you think through it and say, hey, I have other carriers that are operating in this building. They're not a primary on this lane, but they are a primary on other lanes. Maybe they'll have available capacity to support in the event that they need to. Or strategically think how you give your secondary carriers the advantage to be able to support additional freight if and when needed. So I think it's just thinking through those in a different manner. Everyone knows what a tender waterfall looks like or the general concept of it, but how do you take a strategic approach to make sure if and when those levers are needed, that they actually are operational and an effective solution versus just a plan that you have in place?
Yeah, I mean, it's funny too, because you deal with this, and I think you dealt with this internally at times, in your previous life, where, it's, you don't get your door knocked on until something breaks. And in the meantime, it's like, well, I was trying to build out these strategies to help avoid these problems, but I wasn't given the opportunity because nobody's thinking about it. Well, now I think this is a way for you to say, hey, look, for those of you out there that were like me, here's the roadmap. Here's the way that you can present this. And I think data always helps. I mean, there's no CFO on the planet that doesn't respond to data. No good CFO, I should say. And the way that you can kind of say, hey, here's some strategies and here's where it makes sense. Here's the ROIs. On having an appropriate strategy moving forward. And then, of course, it bleeds into this shipper of choice sit rep too that you just wrote. Give us a quick high-level overview. And of course, I'm being told pricing power index and the Sonar sit reps are only available inside the market monitor or inside the research in the bottom portion of the SOAR UI. So call us up if you want some of this, but tell us about the shipper of choice.
Yeah, this is obviously, it becomes more of a buzzword in the type of environment we're in, where when things get tough, everyone wants to look to understand what does it take to become a shipper of choice, right? And it's way outside of just the rate components. It's a really big scope of what are the different parts of your network that a carrier really evaluates. How do they view your cost to serve, and how is your relationship with your transportation providers? And so it looks at things as your facility efficiency. How quickly do you get your drivers loaded and unloaded? How does that program work? Do you make the drivers sit at the dock and waste time for multiple hours? And how does that affect, the way that they view wanting to manage your freight? And payment strategy is another key one. I wrote a separate sit rep just basically on payment terms too, because that's a key indicator into, how you get priority with your transportation providers as well. How quickly do you pay them for the services they provide you? Your freight consistency, that's always one that I focus on, load leveling, volume consistency, how consistently week over week do you ship on your lanes? And so multiple components outside of just the rate side of things. My biggest proponent being on the shipper side was always the partnership aspect of it in any given environment. So you have to have your strategic partners and understand that shippers have their priorities, carriers have their own priorities, and you need to be transparent about what those are to meet an end goal, right? And to work together to say, hey, we have our cost structure, you have your own, savings goals. How do we make sure that those mesh to ultimately make the best decisions for both of us?
And wonderful perspective there, Ben. Thank you so much for coming out on Freightonomics. You're definitely going to be coming back, so might as well. You crushed it today, and thanks to everybody that's viewed today. Be sure to stay tuned tomorrow at noon for more FreightWaves Today.